Jerome Powell at the FOMC meeting.
Look at and remember a card in the middle of the deck. You got one?
Yeah.
Watch. Hear that? Check this out.
Yeah, it's the old classic magic trick, rip and dip. Tutorial dropping soon. So a lot just happened this week because the Illuminati, aka the Federal Reserve, just held their Federal Open Market Committee, and for now, interest rates are gonna stay the same between 5.25 and 5.5%. But what's also kind of crazy is that while all of this is happening, JP Morgan's like, we think Ethereum is gonna outperform Bitcoin next year. I'll take pumping bags that have already been loaded for 2,000, Alex. But the craziest part about all this is that despite interest rates being at their 22-year highs, the investment markets are going way up and setting record highs.
Good day to look at your 401k, people. The Federal Reserve signaled a possible drop in interest rates next year, and that sent the stock market soaring to an all-time record high. The Dow stock index jumped more than 500 points yesterday, landing above 37,000 for the first time ever. That's what a record is, one of many signs that the economy may be moving in a better direction.
Now, the reason why all the investment markets are like, the everything rally is here, is because the Papa Bank, aka the Federal Reserve, is now signaling to the rest of the world that most likely next year they're gonna start lowering their interest rates. Now, even though the market is reacting to this positively and it's going way up, the truth is the market is completely separate from the rest of the economy. And depending on which side of the economy you're looking at, things aren't necessarily doing better because things are still expensive. And even though inflation has come way down and it's lower than it used to be, wage growth still hasn't kept up with that inflation. So in today's video, I want to share with you the Fed's plan in 2024 and what they'll do to interest rates and how much they'll lower by, and how those interest rates will have an impact on real estate, stocks, crypto, and most importantly, everybody's jobs. So with that said, let's get into it. Hi, my name is Andrei Jikh. Hope you're doing well, come for the finance, and stay for inflation. And speaking of inflation, some comments have said that my head looks inflated as compared to the rest of my body. But the truth is, if you ever actually saw me in real life, you'd see that my head actually looks like this. See, this is no filter on. The rest of my videos actually have a filter to squeeze my head back down to normal proportions, and I wanted to save you from that jarring image of my actual head size. So in the economy this week, we got the CPI, which is the Consumer Price Index, which measures inflation, or the rate at which prices are going up. And the latest number shows that inflation has come down to around 3.1%. Now this is for November because remember, data's always 1 month behind reality. The truth is that today, December's inflation numbers are probably even lower, but we won't know what they are until January 11th, as it says on the BLS.gov website. Now, if you want to look at the unofficial numbers, not from the government, we can look at something like Trueflation.com, which shows today it's closer to 3%, which is more or less in line with official numbers. But the point is, inflation's coming down from its peak of 9% in June of 2022, which is good. And the reason inflation's coming down is because gas prices are lower, but some things are actually still more expensive.
For example, eating out at restaurants got more expensive, so did rent for apartments. And get this, car insurance is up more than 19% year over year.
Believe it or not, right now, it's roughly $1,000 cheaper to rent than to buy the equivalent. The average rental rate is a little over $2,100 a month, and the average 30-year mortgage payment is a little over $3,300 a month. Now, the good news is that rent is a lagging indicator by about a year, and rents are becoming cheaper, but the bad news is wage growth still isn't keeping up with some of the inflation.
Taking a look at a recent CBS News poll, 76% of Americans say their income is just not keeping pace with inflation. More than 60% say the nation's economic condition is bad.
Now, all of this is obviously because of interest rates, but here's where it gets really interesting. Because interest rates are responsible for more than just what happens to the investment world, but also how many people get to keep their jobs. Now, as of today, interest rates are going to stay at a 22-year high, but where they'll go next is divided into two alternate realities. What the Fed is telling us and what the market is telling us are two very different things. The Federal Reserve is telling us that they'll consider cutting interest rates next year, maybe 3 times or so. What the market is telling us is that they'll lower interest rates as many as 5, maybe 6 times. So who do we believe? Do we believe the Fed or do we believe the market? Generally speaking, the Fed's job is not to reveal their actual plan to us. The Illuminati don't do that. Their job is to manage our expectations so we don't go out today and spend all our money and cause more inflation to happen. The market's job is to accurately price itself today based on what it thinks about the future and what will happen. Now, the key to understanding and hearing what the market is whispering to us. It's not shouting, it's whispering. And the key to knowing what it is knowing where to look and understanding what you're actually looking at. So let me show you this chart. It's gonna seem a little complicated at first, but I promise I'll just explain it right after. Using something called the CME Fed Watch tool, which you can find yourself, it shows the Fed will most likely not raise their interest rates in January. And we know this because today rates are 5.25 to 5.5%, and it shows an 80% chance that they'll exactly stay the same, 5.25 to 5.5%. But moving on, if you click in March, you can see that in March, the odds are high that it will go down by 0.25%. And this should happen again in May, then again in June, again in July, and again in September, and then possibly maybe in December. So the final rate will fall somewhere between 3.75 and 4.25%, or for the nerds, between 375 basis points and 425 basis points. That is a difference of 1.5% lower than where we are today. So the question is, will this actually play out in the way that I just showed you from the data? And the answer is, if you ever watched the Loki series where there was the sacred timeline, the farther into the future you try to look, the more it splits into alternate realities. And what I'm saying is, if you're trying to predict the short-term future, that's kind of easy because maybe you're making one or two assumptions. But the farther you try to look, the more that prediction is based on an assumption, on an assumption, of an assumption, of an assumption, of an assumption. And the harder it becomes to accurately predict. But assuming that it plays out the way the market is predicting rather than what the Fed is telling us, then yes, they should cut the interest rates by somewhere of 1.5%, probably. But the more important question is, how will those rate cuts actually affect the investment world, and most importantly, people's jobs? So first let's talk about the jobs, because jobs are like an excited puppy. And I say excited puppy because we just got this boy in and we haven't named him yet, but you're the first to see him, and I'll take some name recommendations in the comments. Let me know. How can you say no to this cute boy? Unlike jobs, the market is kind of like a puppy. Anytime it hears rate cuts, it starts jumping up. People want to invest their money because they anticipate a bull market. This is also why you see the greed index is up right now. And that makes a lot of sense. When you think of the Federal Reserve lowering interest rates, you think it's cheaper to borrow money, people start to invest more, there's more jobs around, and good times are ahead. But be careful of how you think about this, because that's not what data shows will happen. Instead, the data shows that anytime the Federal Reserve begins their rate cut cycle, that's when people begin losing jobs. In fact, if you look at the rate cut cycle since the 1950s, the first interest rate drop happens 3 months before people start losing jobs. And this has been true of virtually every single recession that has ever happened. And on average, unemployment goes up to 7.5%, which is roughly twice as high as what it is today. Now this time could be different, and maybe the Fed could achieve the soft landing that they want, which is when people don't lose their jobs, but that would be a first for the Federal Reserve in history. And if you're wondering, well, why does lowering interest rates cause people to lose their jobs? The answer is it actually doesn't. Remember, sometimes it takes over a year for the full pain of people losing jobs to start taking effect. But now let's talk about how these interest rates will impact the investment world, starting with arguably the most important thing you could ever buy, which is a house. So how much does a 1.5% lower rate actually save you? So if we take the market's assumption that by the end of 2024, interest rates will go down by 1.5%, that means for every $100,000 in mortgage cost, your payment would go down by roughly $88 a month. That's assuming your interest rate is 1.5% lower than what it is today. So for the median purchase price of a house today, which is about $430,000, having a 1.5% lower interest rate means that will lower your monthly payment by about $377, assuming 0% down. So almost $400 a month is a lot of money in savings, but you also have to remember those savings will apply to everybody else who will have the same idea of buying the same house with their lower 1.5% interest rate, which means more competition, which means assuming inventory levels stay the same, means that home prices will probably increase. So I did some more calculations to hopefully help you better understand how much they would have to increase by for the lower rate to make no sense. Hopefully that makes sense. So if you have a 1.5% lower rate, the amount of savings that you'll have will be completely wiped away if home prices appreciate by 20%. Now, I am not saying, to be clear, that if the Fed lowers rates by 1.5 next year, that home prices will explode 20%. There's no way that's going to happen because even in 2021, when the Fed dropped rates to 0, home prices appreciated by 18%, which I don't think we'll ever see again. So if rates go down by only 1.5, I don't think homes will appreciate by 20%. All I'm saying is that 20% is sort of like your buffer zone, after which point you're not getting any savings, you're just paying more for a house. Now, when it comes to all the other stuff, like stocks and crypto, for example, here's what I think I can confidently say, which is that if we get higher unemployment, which, as I've shown you, the data shows that once the Fed starts to lower interest rate, begins the Fed cut cycle, that's when unemployment does tend to go up. Depending on how much it goes up, Bitcoin, Ethereum, and stocks will probably go down. And here's why. There's almost a perfect inverse correlation between unemployment and the market. When people lose their jobs and we have higher unemployment, the stock market goes down. And when people have more jobs and unemployment's going down, the stock market goes back up. And if you think about it, this makes so much sense because if you don't have a job or if you lose your job, the first thing a person wants to do is to sell their stocks and sell their Bitcoin and sell their kidneys to pay their bills. But if you have an income and you have a stable job, you're going to continue dollar cost averaging into it. Makes perfect sense. And the same is true of the ultra risky assets too, like Bitcoin, Ethereum, and crypto and everything else. But there is a catch, and there's always a catch. If the Federal Reserve reintroduces QE, quantitative easing, printing money, buying up assets, and lowering their interest rates lower than what the CME Fed Watch tool showed us, then the market goes up bigly. So if you'll allow me to have a theory of my own, I'll say this. If the economy has a soft landing and we don't lose jobs, then the asset market will continue to go up at a healthy pace like it always does. If we have a hard landing and we lose a lot of jobs and there's a recession, all assets across the board will go down substantially. But if the Fed decides to bail us out of said recession by lowering interest rates much lower and reintroducing this QE, then everything recovers big time. And that's about as comfortable as I am in giving my own opinion and my own prediction about what might happen in 2024 based on the data that I showed you, which are assumptions on assumptions of assumptions of assumptions. No one knows for sure what will happen, but if the market decides to skyrocket like it is right now, enticing people to buy into it because it's gonna go to the moon again, maybe be careful and instead build up a bigger cash position and an emergency fund in case you do lose your job. And that's all it's really saying. All in all, I think it's safe to continue to dollar cost average into the market, but also don't neglect that 6-month emergency savings fund just in case we get a repeat of data from the 1950s that tells us anytime the Fed starts the rate cut cycle, people start losing jobs. So just be prepared, be cautious, stay optimistic, and just be careful. I hope you got some value out of this. Have a wonderful rest of your day. Smash the like button, subscribe if you haven't already. Don't forget to grab your free stocks. The links are down below, and then go track them automatically with the spreadsheet link down below in my Patreon. Love you. Thank you so much for watching this video. I'd love to see you back here on Monday and Friday, sometimes a Wednesday. See you soon. Bye-bye.